Welcome back to Trading Hour on CNBC TV 18. Well, Rakshit Ranjan of Marcellus Investment Managers is joining us now to give us an update on the market and how he's seeing things shape up. Rakshit, good afternoon and thanks a lot for joining in. I wanted your thoughts first up on what's happening with the PSU banking space. I mean, the entire space has had a dream run last year. There's some more follow through on the upside. And this morning, Motilal Oswal has put out a very interesting note where they talk about a big improvement in profitability compared to, FY19 and more re-rating on the upside. Would you concur with that view? And would you look outside, the likes of SBI? I mean, of course, SBI has been a favorite for a while, but now has the time come to increase allocation to the smaller PSU banks?
Sure. No, that's a valid observation. That last couple of quarters, the credit cost on incremental retail disbursements that we've seen, the credit costs on recent new retail disbursements have been significantly low for the PSU banks. That whilst that observation is correct, and hence as a result, the fundamentals have been healthy in the last 1 or 2 quarters reported, and might continue for 1 or 2 more quarters as well. We don't know that, but I think that's a more short-term view. The longer-term view is centered on 2 points, which we focus more on. One is that a lot of this ROE, so let's say simple mathematics, the ROE of an SBI, if it is say 15 to 18%, with a leverage of more than 20 times, it effectively implies an ROA of less than 1% and no scope of error. Otherwise, this ROE drops very sharply and the net worth gets eroded with every small bit of NPA in future. Whereas when you compare this against, say, a 15 to 18% ROE of say a private sector bank, say a Kotak or an HDFC bank, the 2 banks that we have in many of our portfolios, our clients, our family, our personal money is exposed to that. So when it comes to a Kotak or an HDFC with the same ROE, the leverage there is only 6 to 10 times, 6 to 9 times, and hence ROA, returns on asset, is a very healthy number. And hence a lot of consistency, downside protection, low volatility to those fundamentals. So that's one piece. The second piece is we don't see the PSU banks having undergone a massive structural upgrade in their ability to assess credit, in their ability to collect repayments. Faster, better, so on and so forth. And hence, yes, banking credit quality is a cyclical aspect. The PSU banks are having an upcycle right now, which is fine. But our investment, given the way our philosophy is structured, is more long-term oriented. And when it comes to that, the private sector banks still have a significantly better fundamental prospects than the PSU banks.
Rakshit, morning. Hi. I know you all hold TCS. You recently added Infosys as well. What was your read-through from the Q3 earnings season, and what does it tell you about the next 12 months for the IT companies?
Yeah, so we had been expecting this sort of an offset to the American recession as a headwind, right? The offset is from a tailwind of vendor consolidation. That was expected. That's happening. I think that will continue for the next couple of years. Every large corporate in, let's say, the US, rather than have 5 different vendors for 5 different verticals within their company, they will probably have one single vendor for all the 5 verticals. And the reason for this will be because over the last couple of years, the corporate would have moved the application to cloud, data to data lakes, and hence a more centralized way of managing IT services requirements. So that's the theme, I think, and that theme straight away plays into the hands of companies that can provide trained manpower at scale rather than just trained manpower without scale, right? And this is where Indian IT services, they significantly have an edge compared to, say, the Accenture, Cognizance of the world. And in that regard, what's happening with the results in the last 1 or 2 quarters, despite the American weakness in economic growth, is quite remarkable, and it's, I think, going to continue. Amongst the Indian IT services companies, there are only two, Infosys and TCS, that can actually provide a very large scale of trained manpower, and hence those two, according to us, will emerge as winners amongst winners, if you were to call it like that, as in within the Indian IT services space, and hence our exposure is to those two.
Got it. Rakshit, good morning. When we spoke a couple of weeks ago, I think you did mention that you still do like the consumption space. Do you think, there's very clearly a premiumization push, right, that we're seeing there, that part of that part of the companies are doing well, and the ones with high rural exposure are not. Do you think that this is a space where you would still feel comfortable putting some fresh money into?
Yes, no, certainly. See, the macro theme, penetration increasing, affordability rising, that's a very long-term theme. That's not the main reason why I would say we are bullish on consumption, because that theme applies to many sectors, not just consumption. What is quite remarkable about consumption in the current time frame is that over the last 2 years, tech investments for a corporate have undergone a massive upgrade. I would say this has been an accelerating theme for the last 10, 12 years, but particularly in the last 2 years, adoption of IT as tools to drive your business rather than just as support functions from the IT spends. That is a massive transition. Companies that are using demand forecasting to drive their competitive edge, companies that are automating their manufacturing, supply chains, distribution, so on and so forth. These have started to become a much bigger part of competitive advantages for many businesses rather than the standard brand distribution, right? And hence, there's a massive opportunity to be had for investors to make money out of companies that are transitioning from old age to new age businesses that are using tech more smartly, more efficiently, and hence suffocating competition in the new era, when the era was not available till 5-7 years ago. You couldn't have reached out to a new customer using the tools that are available today, and very few companies have invested in these tools, right? So that's something which I think we are very excited about in our portfolios.
Okay. I had a slightly larger question. I know HDFC Bank is, of course, in focus today because of its earnings and how it's been industry leading, at least up until now, in terms of growth. But we're also noticing that the entire group is now coming back to the investors' radar after seeing an underperformance for very long, whether it's HDFC Life, HDFC itself. Do you think the tide has turned for the group?
Well, it had to eventually, because the underlying tide of fundamentals was always moving in a very positive direction. Quick disclaimer, HDFC Bank and HDFC Life are both in most of our portfolios for our clients, our family, our personal money. Now, when it comes to HDFC Life and HDFC Bank, if you look at the last 3 years, 4 years, their fundamentals have been compounding anywhere close to 20% annually in a very, very consistent manner, right? Obviously, barring a few excess COVID claims for HDFC Life in 1 or 2 quarters, etc. So with that sort of a book value compounding, embedded value compounding, and healthy profitability only expanding moats, deepening moats as well, I think it just had to be a matter of time. Now, is it going to be a turn of the tide to reverse all of the disconnect between share prices and fundamentals within the next 1 or 2 months, or will it take sort of 6 months? That's anybody's guess, and I won't be able to answer that question. But yes, the tide had to turn because the fundamentals were already on the up and the share prices weren't. And yeah, we're looking forward to it in our portfolio.
Rakshit, we'll have to leave it at that. Thank you very much for joining in. Flat for the markets now, the Nifty and the Sensex, the Nifty mildly in the red. The two big sectoral gainers, one is the IT pack. The Nifty IT index is up 1%, and the top 3 Nifty gainers today are from the IT space: Tech Mahindra, HCL Tech, and Infosys. And outside of the index, it's the PSU banks which are ruling. UCO Bank, IOB, Central Bank of India showing you gains between 5 to 6%. So the PSU, the Nifty PSU banking index is up 1.5%. So IT, the winner in the large cap space, and PSU banks outside of the index in the mid cap space. Need to slip into a very short break on that note. But as we do that, here is an important information for all our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list.